Well, hey there, everybody. Dave Keller here with Market Misbehavior. Welcome to Chart This with Dave Keller. It's Wednesday, July 30th. Happy Fed Day. Happy Fed meeting. Happy market volatility. Happy heavy earnings day. All of those things wrapped up into one. That's where we're at. We're coming to you live from a beautifully sunny, not too hot Redmond, Washington. Hope you guys are all staying cool and comfortable wherever you're at around the world. And I appreciate you so much, those of you tuning in live here for the show. As a reminder, we live stream on Facebook, LinkedIn, YouTube, and X. I appreciate you tuning in live. If you're doing so, please take the opportunity to drop questions as we go. Anywhere where you can put a comment on those platforms, I can see them here from the live stream platform. And we'll take a question or two at the end of the episode. Really appreciate the conversation that tends to be going on as I'm talking. Helps me to just think about which areas resonate with all of you, and thinking about some topics to consider as the show progresses, and also in future episodes. So I really appreciate it. If you're watching the replay on our YouTube channel, questions always welcome as well. Just drop it in the comments section below the video on YouTube, and we'll try to address them in our Friday all mailbag episode. Let's get right to the market activity. Obviously, a lot happening today, and again with this sort of show. I mean, I assume, and from the questions that I get, I doubt you're using this show as your main news source for what happened with the Fed announcement. I'm going to assume that you're doing that elsewhere, and that's fine, because there are smarter people that are much more into Fed policy decisions than I am, that could probably give you some interesting insights. My goal is to take what you've probably read and learned, add a technical analysis overlay, a behavioral overlay, help you just think about how the trends are shifting, looking for potential changes of character, and just trying to help nudge your thinking a little bit, hoping that you can develop good habits for the next bear market phase. I did an interview earlier this week with Adam Koch for his podcast for financial advisors. I don't believe that's out yet, but hopefully very, very soon. And one of the things we talked about was just the purpose of looking at charts and how you're making sense of them, right? What you're actually using that information for. And for me, it helps you understand what's happening and helps you identify potential shifts. It helps you acknowledge when the market has changed, right? And at the end of the day, I think that's how you get around behavioral biases. I think that's how you make better decisions, is you have an evidence-based process, not an emotion-based decision-making process. So I'll do my best to help you focus on the evidence here for a short while together this afternoon. With that in mind, choppy day today, Fed creating all sorts of volatility. The market spiked initially after the Fed announcement, basically no change in Fed policy. I mean, zero surprise there. The market was basically pricing in an almost 100% chance of that being what happened. So the Fed meeting was more about the after party, the press conference, Powell's comments. But then once the Q&A started, you could just see the market accelerate to the downside as Powell was asked about, the Fed independence and, Trump visiting the Fed building construction and all sorts of things, and just, likelihood of a September rate hike or rate cut, et cetera, et cetera. At the end of the day, those comments all sort of, I think for me, as I'm listening to Powell, I did watch the press conference live just to sort of see what sort of reaction there was. It struck me that the Fed's dual mandate, right, of maximum job growth and keeping prices stable are that is just such an impossible task that they're asked to do, right? And it's like one of those is going to be a miss, I feel like, at any point. It's so hard to get that right, especially with the lag between anything they would actually do and what happens after. So that was my takeaway, was just, wow, this seems like a really challenging thing they're trying to do. I don't know how this is going to go well. And sure enough, market sort of rolled over. Comments about tariffs and potential impacts certainly came out of that as well. With that in mind, nice rally going into the close made the S&P only down by about 0.1%. That's 8 points away from where we closed on Tuesday. So that could have been a much worse day. I mean, as the market was selling off during the Powell press conference, it felt like we could be just going below 6,300 by the close, but found some stability and ended up rallying into the close. So the S&P, not far off of all-time highs, right? We're at 63, 62 and change. The NASDAQ composite up a bit today. Up about 0.2%, Dow down about 0.4%, mid caps and small caps both down about 2/3%. VIX actually coming off of it today, right? On Fed Day, VIX going down to around 15 and a half. So we're still in a low volatility environment. The S&P and the NASDAQ are still, making new all-time highs this week. And we really did not see a ton of distribution. Again, a bit of a sell-off after the Fed press conference, but not any huge red flag warning signs of any sort here. We'll see, right? We've sort of seen these random, red flag kind of things, right? Like a big sell-off during the press conference, but not anything that really changes the trend. And I think that's what my process really I've evolved to try to focus on is trying to separate tactical noise, movements, initial kind of gut reactions to things you see and hear versus cyclical or medium-term trends, which is more of that kind of, month, couple weeks, couple months kind of rotation that will happen versus long-term secular trends. And to be honest with you, anything I'm seeing at this point, still very tactical, right? You're not seeing any sort of medium-term or long-term warning signs, at least in the stuff that I'm looking at. We'll definitely keep you updated because we look at this stuff every day and enjoy doing the show to share some brief insights with all of you. Bonds sold off today. The TLT was down about 0.5%. Rates generally moved higher. The 10-year point finished near the highs of the day, right around 4.38. The long bond yield just about 4.9%. 5-year point finished just below 4%. Dollar index up about 1%. We've seen now a rally in the dollar this week, which is maybe not insignificant. This has been the biggest. A lot of times in the news, someone will be quoted as saying this is like the biggest 3-day move in history. I'm so not a numbers person where I have that kind of stuff readily available. I love watching like Ned Davis research, Ryan Dietrich, from the Carson Group. These are people that are really good at that kind of thing. I'm a fan of when they can do the work and share the results because I don't have that sort of quantitative chops that I'm just throwing around running numbers. Having said that, I'm noting that the dollar's up quite a bit this week, and I think that could be an interesting note because that's not been the trend in 2025. We've had a weaker dollar for pretty much the entirety of this year. Looking at the commodity space, anything stand out? Something down almost 20% today. Copper prices. Here's your latest headline related to tariffs: 50% tariffs. Not on, spot copper, but basically on copper products being announced today by the White House. So copper prices down significantly. Freeport-McMoRan, Southern Copper, kind of those copper miners probably going to get dinged pretty good as a result of that noise. I think I grabbed the chart of FCX once I saw that was happening. That came in toward the end of the day. Gold and silver down as well. The GLD had a pretty consistent downtrend through the course of the day, and specifically in the afternoon. So gold down almost 2% today, silver down over 3%. So precious metals started to roll over pretty aggressively in here. That actually is one of those things that at some point, if you start to see gold weaken and weaken and weaken, you have to start to, think maybe there's a bit of a change there. I actually did sell some of my position in the GLD earlier this week, and we'll see if I do more of that. I still have a decent bet there, but for now, seeing enough weakness and just seeing other places where that could be allocated, then I'm rotating things a bit. So we'll see. But at some point, a short-term move becomes a medium-term move, and a medium-term move becomes a long-term move, and kind of making that decision. I think that's where the focusing your time and effort can really pay off. Cryptocurrencies generally weaker today. You can see a lot of those sold off during the equity trading session with a spike here in the last hour or so. Bitcoin's currently trading just above 117,000. It did bounce briefly below 116,000. Ether prices and the rest of the top 10, most of those down today. All right, looking at the 11 S&P sectors, utilities, not the traditional offense we might want to see at the top of the list. The XLU up 0.7%. Communication services and technology, two of the FANG sectors, and two sectors with big earnings reports today in the form of Microsoft and Meta. We'll get to that here in a bit. By the way, we'll look at both of those charts, talk about the after hours, both of them having some pretty nice upswings after the market close during going into and coming out of that earnings call for both of those. So strong quarters all around, and looks like pretty solid upside follow through. And that's what keeps benchmarks in really good shape. Big, huge names like Microsoft and Meta having strong earnings, something we talked about as a potential outcome this week. Certainly looks like that's what's happening today. On the downside, materials down over 2%, energy down 1.4%, about the same for real estate. So some of the cyclical sectors and defensive sectors rotating lower. Not a great day breadth-wise, but this is one of those days where, I mean, it was kind of a choppy day, particularly in the afternoon, post-Fed. But this is one of those days where even if the breadth is really pretty bad, right? So 70% of the New York Composite Index or the New York Stock Exchange members were down today. But if Microsoft and Meta have big up days, right? I mean, it's more than enough to offset breadth data this week. And this is something, this is a pattern we've seen in previous market cycles when it's the mega cap growth trade that's really working, right? When technology kind of sectors are doing well, breadth can be weak and the benchmarks can still go higher. That doesn't mean the benchmarks are weak. That just means that maybe like a lot of stocks are not really doing the same thing as the benchmarks potentially. So something to think about. But breadth across the board today, not great. Worst in small caps, where 75% were down. So that's about a 3-to-1 ratio of stocks down versus higher. I don't think I actually grabbed the chart that I really wanted to. So I'm going to do it right now in front of all of you. Sorry about this. Sometimes on days like today, where it's like a sprint into the close, I get about 80% of the way where I need to, I feel like, where I'd like to be. I have grand plans, as always, to be completely organized for this show. And it rarely is as good as I want it to, but I'm going to put it on the list right now, and then I'll remember to get to it in a minute. So thanks for bearing with me here. We'll say this is here. There we go. Good enough. I can handle that. All right, going back here, I just want to check in on the Magnificent Seven stocks. Here we go. NVIDIA up 2%. Broadcom up 1.8%. So strength in technology still obviously a non-issue. Microsoft was only up about 0.1%, but after the close, it looks like it's popping up pretty well. We'll see. We'll check here in a minute and see exactly where it's trading. Netflix even getting a bid today, up about 1.3%. This is, I mean, arguably the weakest of the Magnificent Seven charts at this point. After making an all-time high at the end of June, the month of July has been, just nightmarishly negative, below 1,200. I think from a tactical perspective, it's like Netflix above 1,200 at least is not going down as much and starting to show some stability. But, today's a nice bullish engulfing pattern, maybe suggesting a short-term bounce, but not enough to really be excited yet. Apple down about 1%. That's going into tomorrow's report. Amazon down about 1/3% going into their earnings tomorrow. Tesla, Meta, both down about 2/3% today. All right, we'll go to the market carpet. This is a heat map where we like to look at what happened today across the 500 members or so. It's actually about 505 stocks in the S&P 500. Did you know kind of moment? But we'll look at the heat map and see what conclusions we can draw. As a reminder, I can see questions and comments on those live stream platforms that we mentioned. Please drop questions in if you're tuning in live as they come pop in your head. I'll try to take a question or two before the end of the episode. Anything we don't get to, we'll put in the mailbag for Friday's all mailbag edition of the show. Right, so the heat map, very mixed today, right? And you saw breadth was more negative than positive, and a lot of that negative breadth really was on the right half of this heat map, which is where it's more cyclical sectors, kind of more value sectors, and more defensive sectors, right? Particularly if you look at energy, if you look at real estate, if you look at materials, those are kind of the three in the bottom right quadrant. That's where almost all of those were down. Random stocks like a Nucor, popping higher, but generally these are sectors that have struggled here today. Also, you see, like in industrials, very much mixed results, right? There are stocks in the industrial sector that look absolutely fantastic. There are charts in the industrial sector that look pretty bad. And then there are a bunch in between. It really is a fairly diverse sector when you think about the types of stocks that are in there. In industrials, you've got kind of big conglomerate, diversified industrials, as we call them. You've got aerospace and defense names, charts like GEV making new all-time highs today. You have heavy construction names. You have shipping names. You've got railroads. You've got airlines. I mean, it's just this whole mix of things. So it's not a very homogenous sector, right? Certain sectors like energy, kind of more similar. Real estate, kind of a lot more similarities between those names. But industrials in particular, a lot of groups doing a lot of different things. So not surprising that there's very mixed results here today. But charts that stand out when I'm thinking of the industrial sector: UPS pounding out a new 52-week low today. That's not great. 3M, which actually made a new breakout high earlier this month, now pulling back and getting back below that breakout level. RSG, right? I mean, in charts like this were really good up until the end of May. A lot of stocks actually had a lot of strength until the end of June and then rotated lower. Republic Services, which is basically trash, right? Waste disposal services, I think, is the group. Classic uptrend, right? At the end of May, I mean, it's hard. I would argue classic uptrend phase. And as a trend follower, it's recognizing when this pattern changes, right? And what I would encourage you to do, if you've never done something like this before, is take a chart like RSG, even if you haven't traded it, and go back and actually look at the chart one by one and just think about where you would have decided, to unwind a position, right? And just think about what changed from this period, right? What makes this a very bullish chart, which I think is totally fair. What warning signs did you get in April, May, June, if any, that told you maybe we were near the end? What confirmation did you get in June and July suggesting weakness? And, at the end of the day, I think it comes down to trend, right? What the moving averages look like. Are they sloping up or sloping downwards? Or is the price above or below key moving averages? Are they crossing over? Those are all things you can use to understand them. The momentum, right? Is the momentum more in the bullish range, generally above 40, or more in the bearish range, generally below 60? Relative strength, is it outperforming or underperforming? And I think if you think about, look at classic chart tops and dissect them. This is what William O'Neill, legendary investor and educator for a whole generation or two of investors, basically made a name for himself by going back through previous winners and looking at the characteristics of good companies before they exploded to the upside, and just looking for similar breakouts in the future. I think you can do the same thinking about risk management. Use this as a case study to think about what tools and techniques can help me acknowledge an uptrend that is no longer working. And I would say for now, RSG definitely heading in the wrong direction. Finally, with technology and communication services, we've got a lot of earnings this week, of course, in a lot of different sectors. But particularly, we've got 4 of the Magnificent 7 names. We're going to talk about Microsoft and Meta today. We are also tomorrow going to talk about Alphabet and Amazon, which is in the consumer discretionary sector. But again, charts like NVIDIA just continuing to look fantastic. Charts like Microsoft continuing to look fantastic. Probably, most likely, if not definitely, making a new all-time high tomorrow. So within technology, there are plenty of charts in primary uptrends. And I think at this point, while we may want to think, all right, at what point do you start fading strength? As a trend follower, I'm a fan of following strength as long as it continues to be strong. And I would say a lot of those charts definitely fit that description. I think that's it for the heat map. Let's continue on, and we'll go to the charts here. Looking at the S&P daily chart, we highlighted yesterday what's called a bearish outside day. That's where you have an up day. We have a second day, a down day that is a wider range than day one. The S&P chart really wasn't a bullish engulfing pattern. That would have to be an up day and then a down day. This was like a down day and another down day, but it still counts as a bearish outside day, which is a wider range and a down close on day 2. Suggests the next 1 to 3 bars are lower. And today we ended up going a slightly lower here. Tomorrow certainly feels like, with Meta and Microsoft doing what they're doing after hours, most likely you get some strength tomorrow. You get a bounce higher tomorrow, but we'll see. The short-term chart of the S&P, still in great shape, right? Still making new all-time highs yesterday, still above an upward sloping 21-day EMA. As I've highlighted a number of times, in this sort of environment, I'm inclined to assume that this trend continues until it doesn't. And the way that you can tell it doesn't is where we stop remaining above all those upward sloping moving averages. Look for those to start to break. That means S&P above, we'll call it 6280, is a pretty good chart, right? And anything above there, I would say, is just normal volatility. Anything below that 21-day EMA would tell me maybe we're starting to change to a different sort of structure. For now, this chart is quite strong. Momentum improving quite a bit. Now, not all of the major indexes have strong momentum this week. And I would say if you look at the S&P 500 and the NASDAQ, you can't really describe those as having bearish momentum divergences, because they've made new highs here in the last week or two. Late July on stronger momentum. The RSI has been overbought. But if you look at the NYSE Composite Index, which is what we're looking at here, if you look at the mid-cap ETF, MDY, if you look at a small-cap ETF like IJR or IWM, you're going to see a bearish divergence, right, of higher highs in price, weaker peaks in momentum. I mean, that is a classic bearish divergence, suggests a likely market top here. So it's an interesting kind of juxtaposition that half of the indexes are showing a divergence and the other half are not. So what gives there and what do we do about it? So this is where I think the breadth conditions are starting to deteriorate. We're seeing that again today. Divergences like this on a New York Composite Index, a broad, group of stocks, is suggesting that there's weakness underneath the hood. But the biggest names, and for better or worse, the names that matter the most in terms of the indexes and a bunch of passive investing that is tied to the performance of the S&P and the NASDAQ, conditions are quite good. And that's because the biggest names are still looking so good. So the problem occurs most likely less when the breadth gets negative, but more when NVIDIA and all the NVIDIAs of the world stop looking so amazing. They still look amazing today. So divergence is there. If they break down, that's a valid divergence and downside follow through. But the major indexes that are driven by those mega cap growth names not being nearly as weak here. We are seeing some weakness in volume, and I did want to highlight here. It's still early days to call this a huge warning sign, but look at the volume here. This is the Chaikin money flow that we're looking at. So this is the daily S&P 500 volume reading, and then this is the Chaikin money flow. The Chaikin money flow is an indicator Mark Chaikin developed using daily volume bars, but weighting the daily volume based on the movement in the price. So if a stock closes or an ETF closes near the highs of the day, that day's volume is mostly bullish. If a stock or ETF closes near the lows of the day, that day's volume is more bearish or more distribution. And so it's an oscillator built on the 21-day look back there. So it's basically saying over the last month, has the volume been more accumulation or distribution? As long as the indicators in green above zero, that means it's more accumulation. Below zero would be distribution, would be more bearish. It's still bullish. I mean, it's still above zero, but you're starting to see it go lower here in the last couple of weeks. So the volume is suggesting some distribution days, particularly this week, with some heavier volume on some down closes. So still early on, but that is one of those like early warnings that's popping up here that I'm seeing as well. All right, with the S&P 500, this is the chart I wanted to save earlier. Someone mentioned it in the chart. I'd meant to grab this one and I didn't. Breadth has started to turn over a little bit. It's still not bad though. I mean, I would say the breadth day to day has been more negative. But for me, the stocks above their 50-day moving average still around 62%. Now that's down from around 76% about a week ago. So it's going in the wrong direction. But it's still well above 50%, which means well over half of the S&P names are still above their 50-day. If that goes below 50%, you'll hear me make some noise about it. The long-term breadth, stocks above their 200-day moving average, still very much in a bullish framework. It's to around 61%. If it gets below 50%, that would be concerning for me. And this indicator, at times has been just absolutely fantastic. I mean, just the fact that it remained bullish for the entirety of 2024 was just a fantastic reminder that the trend overall was still quite constructive. When it did break below the zero level in early March, that was a great confirmation that was a major top in February that probably had more deterioration. It didn't go back about 50% till like early May, which is one of the many reasons why I was probably way more bearish than I probably needed to be right around here, because we still had many stocks in primary downtrends. And we hadn't really gotten above the 50% level. But then you can see in early May, both of these kind of flipped above 50%, suggesting a lot of stuff was recovering. And there's probably upside momentum and that's what's led to much further gains over the next couple months through today. So for now, they're still fairly constructive here, both above the 50% level. That's the level I would be looking for. For now, they're okay. I was asked yesterday about the VIX. And VIX divergences. I forget where I actually got this question. This might have been one of my premium members that actually asked about this. And I apologize, I forget. But I grabbed the chart when the question was asked. Someone asked about, is there a divergence between the VIX and the S&P? And the answer is not really. The way that you can look for divergences between the VIX and the S&P is you want to invert the price of the VIX. So this is the VIX plotted upside down. Different charting platforms have different ways of trying to do that. On stock charts, you just add a minus sign before the ticker, and that just inverts the scale. On some of the charts, there's like a little dialog box, a little box where you can select invert scale. On Optima, which is another platform that I've used for years, that is fantastic as a technical analysis platform. Just has an easy ability to invert the scale. It can be helpful if you have things that tend to have an inverse relationship, to invert one of them so that you can just look at them more on an apples to apples basis. So by flipping over the chart of the VIX, right? So lower on this chart means a higher volatility. So we can see how volatility has been coming in here as the values have gone lower. That's lining up with the S&P that is plotted in its normal shape. So we have lower volatility on stronger stocks. So I would say this is actually following the traditional pattern. If we would see the market going higher and the VIX start to expand, that would be a divergence, which would be pretty bearish for stocks, I would say, because that would mean market's still going higher, but the volatility is increasing, which means the anxiety level is increasing, which means people are getting nervous, which means they're probably going to stop buying at some point and start to panic and unwind. We've seen some of that divergence before. It's not my favorite divergence tool to use. I'd much rather look for momentum divergences. And the reason why is, like, if you look here, right, like late 23 through like the first quarter of 2024, the VIX was generally trending higher, even though stocks were going higher as well. So the divergence lasted for months and months. So this isn't my favorite divergence. So someone asked about it. I wanted to share this with you, that yes, you can look at that relationship. Is it the most meaningful divergence? 100% no. I would be way more interested in divergences with momentum, which is using like RSI or PPO or MACD or one of those indicators. Divergences with breadth, comparing the trend in the S&P to like the advanced decline lines or the McClellan oscillator or something like that. This would be way down the list of divergences. I think that probably would test very well if you ran a bunch of back tests on it. Would be my assumption. All right, let's talk about some stocks here. Microsoft and Meta both reporting after the close. From my initial assessment of the results, pretty solid. And for Microsoft, Azure, the whole cloud part of their business, just screamingly bullish, given everything that's going on here. From a technical perspective, going into today, there's not much to not like about the chart of Microsoft. We most recently had this hammer candle pulling back to an ascending 21-day EMA. We've bounced off of that. The momentum has been fairly strong, like a little bit of a divergence here in the last week or two, but like not much. This has been a leading stock in a leading sector. And so overall, pretty good place to be. Let's go here and look at what's happening after the close. Yeah, currently up about 7.5% to around 552. So the stock's like up here now. So definitely an upside breakout, continuing the uptrend that we've seen. We'll see what happens in the normal trading session, but it looks like this earnings release is going to keep Microsoft in a position of strength. And if Microsoft, closes up 7-8% tomorrow, the major benchmarks are going to be up. I can't imagine they would be down in any meaningful way if that's the case. Now, Meta, a little more nuanced, right? Microsoft has been in a primary uptrend. Reminds me of like the NVIDIA and other technology charts that are just kind of long and strong up and to the right. Don't touch them. Just continue to ride the uptrend kind of trends. Meta's a little more nuanced, right? Meta with an arguably a big double top pattern with resistance around 740. That was a level here in February. That was a level again here in late June. We've pulled back to the 50-day moving average, but setting up for a pretty decent bounce to the upside, to be honest with you. After the close, up about 10%. We'll see 71 points or so. So we're like 766. We're like up here. So if that's what happens, then what that's going to do is it would confirm, I don't know if you call this it's not the most perfect cup and handle pattern I've ever seen by any means. But what you do at the chart of Meta, or at least what I would do, is think of it this way. Here's the resistance, right? Here's the resistance from February. Make it a horizontal line there. You see how well that lines up with the June peak. What we've been talking about recently is this could be a big double top pattern. And if you break down enough, that completes and sort of validates that pattern. It's not quite enough yet because we're still holding the 50-day moving average on decent momentum. Or we break out above 740, which would mean completing a cup and handle pattern and suggesting much further upside. And it looks like, based on what we're seeing today, assuming a nice follow through tomorrow, that suggests a nice upside breakout and basically turns this into a classic cup and handle pattern. So if Microsoft is breaking out on earnings and then Meta's breaking out with a cup and handle pattern on earnings, this market can go a lot higher, right? With those big names, with the weight that they have in the index. So, I mean, most likely it looks like this week is going to continue to push to the upside. Now, those earnings don't happen in a vacuum, right? So we also have PCE data. We've got Apple and Amazon. If they miss tomorrow, certainly can change things, but we shall see. Freeport-McMoRan getting dinged with the news in copper. And so you can see FCX down about 9.5%. And overall, this takes Freeport-McMoRan back below the 200-day moving average, back below the 50-day moving average, back below all the moving averages just in one day. Now, it had broken below the 21-day EMA back here, and that's one of the things that this is why we focus on that as an initial level, right? It's like as long as we remain above the 21-day EMA, things are still pretty good. But if we break that, that's when it starts to be a problem. And that problem really was confirmed on Monday as we finally broke below there. Today, we plunged below the 50-day, below the 200-day. FCX below the 200-day is not a strong chart anymore. And we've broken down through trend lines. It's really showing a sign of distribution. The momentum is obviously quite weak here. So this is the kind of chart I would look for a break back above the 200-day as an initial level of, okay, that would tell me at least we're recovering. For now, this is the kind of chart I would avoid until you find some stability, figure out where that next low is going to be and give some sort of framework. Fibonacci retracements, we don't have time to go through, but that's certainly something I would think about for identifying some potential levels to maybe layer in with a speculative position if you're okay with buying in on weakness after a significant drop. TTD was a name I was asked about recently, and I think there's a fairly constructive chart. And the reason why I think it's constructive, look at the Fibonacci retracements. If we take the December peak, which is around 142, we take the low here around 42. Talk about a big percentage loss from point A to point B. It doesn't look like much on the chart. That's a huge drop in value. Then we go all the way up to 80. So it's almost a double just to get to the first Fibonacci retracement level. That's how big of a drop that was. That was resistance. We can see we finally gapped above there, and now that's held. And so I think when that sort of move happens, I think that's a pretty encouraging chart. For me, the real bullish breakthrough is when we get through the 200-day moving average. I think that was what would indicate much further upside to be had. But I like the breakout. As long as we hold that 80 level and hold the 21-day EMA, I think that's a pretty good short-term trend that may be worth following here. Biotechs, I often show the IBB. Someone pointed out in the chat yesterday, I always look at IBB. I never look at XBI. I mean, there's only so many stocks and ETFs you can look at in any given day. And in the world of ETFs, there's so much redundancy, right? I mean, if you think about just how many ETFs can you name that track the S&P or a similar structure, it's like you only need one, I think, right? I use the SPY. You can use whatever, but you only need one, and then you get a sense of what the S&P is doing. Same thing with biotech. I've used the IBB for longer, and so that's the one that I use. I don't blame you if you use this one, and maybe there are some nuances between the two for sure, often in terms of how they're weighted and other things like fees and stuff like that. But particularly the XBI is showing an interesting pattern here because it's rallied up to a descending 200-day moving average. So in the short term, it's been a pretty nice rally of higher highs and higher lows. Now we're below the 200-day moving average. We stalled out there a number of times in January and February. I think this chart above that 200-day becomes a really solid chart with upside potential. So for me, I set an alert around 88.50 or so. Getting above that, I'm writing this down to make sure that I do that. But I think that'd be a really nice signal for biotechs with further sustainability of that uptrend. Overall, I mean, nice trend off the lows. The higher low here in May, really encouraging. Getting back above these moving averages. This is where it becomes a pretty constructive chart in the short term. More of a long-term sustained rally. You need to get above the 200-day, which is right about where it's at. Just wanted to update on two stocks that reported after the close yesterday. We talked yesterday on the show, Starbucks was kind of this consolidation range. Today, we literally filled in the rectangle. We opened right at the top part, which was where we had a peak in July and a number of times in July. We traded briefly above there, but then back into the range. We traded down on an intraday basis right to $90 a share, almost exactly to the penny before rallying off the 50-day moving average. So if you're looking for some closure today, you didn't get it. We opened higher and closed lower. So it's more weak than strong in the fact that we closed lower today, but really not exiting this range in the way that we highlighted. So for me, it's still neutral until we get out of that range. So that range ended up being pretty decent of a range that ended up today's action really play it out with. Booking is another one. For now, holding its 50-day moving average. I thought that was interesting that we opened below, but actually closed back above it. I see that as pretty encouraging price activity, right? Looking at what happens on one day can be like feel sort of random, but looking at the price behavior around a major support level can be kind of helpful because it helps you understand whether there's accumulation at the point where you might expect that to happen. So I like the rally back above the 50-day moving average. Feels very much like a buyable dip for a pushback to 5,800, maybe higher. And a confirmed close below the 50-day moving average, I think, negates that kind of bullish short-term setup we may be getting here. All right, we'll take some questions. I see a lot of chatter about so many different things, and I appreciate you asking about all of this. Let's see. Breakpoint trading. Thanks for watching on YouTube. You mentioned the McClellan indicator below zero. 100% true. And I've mentioned this randomly. I have maybe not made as much noise about it as I could have. When I think about the McClellan oscillator, I mean, it really is a short-term breadth indicator, and that's what the McClellans, when they designed this indicator decades ago, it was to turn the advanced decline data, which is more of a long-term, analysis of breadth conditions, and turn it into a short-term gauge. This was meant to really think about the swings in the market using the advanced decline data, right? For the longer-term gauge, right, they created the McClellan Summation Index, which attempts to kind of turn it more into a trending indicator. I would argue just the cumulative advanced decline lines do that job very, very well, I would say. So we're kind of already analyzing that in other places. So this is more looking at the short-term breadth. And you're right? As I think we've hopefully covered pretty well, right? Days like today have become the norm here in the last couple of weeks, right? The breadth has started to be short-term weaker, but the McClellan oscillator is more of a short-term measure of breadth changes. So it is certainly telling over the last couple of weeks there's been more weaker breadth. We're seeing that on today with more decliners and advancers. We've seen that a number of times here in the last week or two. But are the long-term breadth indicators really changing? I would argue not really, right? The bullish percent index is still pretty high. The cumulative advanced decline line still in uptrends and above their 50-day moving averages. Well over 50% of S&P members above their 200-day moving average. So kind of those long-term measures of breadth are still okay. So short-term breadth, 100% starting to weaken. Can the market go up with short-term breadth measures being negative? They clearly can because they're doing it this week. But certainly something to watch. And when other breadth indicators start to look more like the McClellan oscillator, that's when I think we have some real issues to think about. Let's see what else here. Yeah, 3P investor, thanks for being a longtime supporter and watcher. Rationale for lighting up your gold position, profit taking, are based on some technical factors. I mean, I hesitate. I sort of with this closing trades, I feel like it's something that's part of the standards we all agree to. It's like if you talk about something, you should disclose, hey, I have this position. Hey, I just bought it. I just sold it. To be honest with you, I have the same issue with telling you those things that I do with looking at insider data, right? When a company insider sells a ton of the shares of their stock, that doesn't necessarily mean they're real bearish on their company. That could mean they need to buy a boat, or maybe not. No, they want to buy a boat. They need cash for something. They need to raise cash to send their kids to school or something, like who knows what it is. They need capital, right? When they accumulate shares of their company, that can be interesting because they could put their money in a lot of places. They're choosing to put it in this thing. So, for me, this was less of I'm really bearish on gold. It was more, I needed to raise cash for some things as part of general money management of my own. I'll leave it there. And so where do I take it from? Gold, which has already had a really good run, that is starting to show some short-term weakness. That's where I tend to want to lighten up, right? Those are your cash sources, right? When you think about raising cash, right? It's like we need cash for something, whatever it is, whether it's a new position, whether it's something outside of the market, like you just need cash available. So where do you raise it from? I look for positions like gold that have been really good winners that I'm probably thinking of starting to lighten up anyways, just because it's had a really good run. Maybe I want to reallocate to some other things. So when I need cash, it's like, all right, let me look for some of those positions. Gold was a very obvious one. And the gold had done so well that position had gotten a little bigger than I'd wanted to anyways. So it was sort of a mix of rebalancing and raising cash, I would say, altogether. And from a technical perspective, short-term weakness within the long-term uptrend seemed like a pretty decent opportunity. I wouldn't read any more of it into that. But yeah, that was the story. All right, last question. Where would you, Jeremy, thanks for watching. You said, where would you draw the gap on Dollar General, May 20th high or June 2nd, day before the gap? When is a gap support and when is a gap a retracement magnet? I like that, retracement mag. Good name for a band, retracement magnet. All right, DG. Thanks for the question. Where would I draw this? Where would I draw this gap? So there are different methodologies for for gaps, and some may disagree with how I characterize them, but you're watching my show, so I'll tell you my version of it, right? Where do you draw the? I mean, for me, I would tend to immediately think, and hold on, you're saying, oh, June 2nd, yeah, like right here. May 20th high. Oh, I see what you're. Okay, fair question. You're saying, do you draw the gap like here, which is basically saying like the May high, or do you draw it down like this? I get your point. So technically, you draw it like this, right? Because the price gap is no overlap from one day's trading to the next. So the gap that occurred was from this day's range to this day's range. That's the gap. Now, I see what you're saying, which is like, would you use this? But not really. I mean, I would just kind of think of this as the overall gap range, because that really is the price gap by definition is the no overlap from one day's trading to the next. So whatever happened to the left of it doesn't matter. It's really what happened right there. Same thing like here. I think the gap you want to draw is really, it's from this. It's all the way up to here, right? You wouldn't use that low. You kind of use this point because this is where things change from day one to day two. So best practices for gap, think about the lack of overlap from one day's range to the next. That's how you want to think about it. Now, does it matter that there was a high here? Maybe, right? I mean, so like depending on here, probably not as much, but what I think about that potentially, like, yeah, maybe that might come up later. The fact that there was a resistance level in the middle there. But in terms of the price gap, this is how I would generally think of it. And what that means then is there's this area of support. And I tend to think of gaps more as support ranges or resistance zones, right? Like more of an area where instead of just a particular level, it's more of a range. And I think that's an effective way to think about it. For me, that's been very, very helpful because there often ends up being support and resistance within that zone. The Ichimoku cloud, by the way, is a kind of a dynamic version of that strategy. Maybe that, to be honest with you, maybe that's where I got it, was back in the day and talking with Japanese traders that primarily used candle charts and Ichimoku clouds. And I love the fact that there was this range you were working with because it gave you a lot more flexibility to not worry about one individual price point, but more about ranges where you could accumulate or unwind positions. Thanks for making me think about that one. And thanks for the very thoughtful questions. Appreciate your questions today. Appreciate you guys watching. If you're watching it on delay on our YouTube channel, please put a question in before you leave in the comment section. We'd love to hear from you. We'll do an all mailbag episode on Friday. In the meantime, have a great week. It's a beautiful day here in Redmond. I'm going to put on hiking gear and get out on the trail and enjoy some beautiful weather. I hope you have an opportunity to do the same in some way to release and take a nature bath and free your mind a bit. But in the meantime, have a great evening. We'll be back tomorrow. And here to remind you, it's always a good time to own good charts. Have a good night, folks.